cost basis is your starting point for a lot of deductions. Depreciation, amortization, depletion, even casualty and theft losses all lean on basis. Here's the scary part. If you can't substantiate basis, the IRS can treat it as zero. On the EA exam, that usually means no depreciation and a much smaller loss deduction. So your job is to build basis correctly and document it. Initial basis is usually cost, what you paid to get the asset, but cost is bigger than the invoice price. Think, all the amounts necessary to acquire the property and get it ready for its intended use. On exam questions, they'll hide these costs in the fact pattern and see if you accidentally expense them or ignore them. If it's part of acquiring and preparing the asset, it usually increases basis. Common capitalizable acquisition costs show up again and again. Sales tax and excise tax on the purchase, freight or shipping to get the asset to you, installation and testing to make it operational, and professional fees tied to acquiring the property, legal and accounting. Also, watch for revenue stamps and recording fees in real estate deals. These aren't extra, they're part of the asset's cost basis. Real estate has two classic basis traps. First, legal fees to defend or perfect title get capitalized into basis. That's not a current deduction. Second, assumed liabilities count as cost. If you buy a building and take over the mortgage, that mortgage is part of your basis, even if you didn't pay it in cash. On the EA exam, assumed debt is often the biggest number in the problem. Now separate basis of the property from basis you depreciate. Land is not depreciable, so you allocate total real estate cost between land and building. The exam will hand you a land value, often from a tax assessment, and you subtract it to get the building's depreciable basis. Also, improvements made before the asset is placed in service typically increase the building's basis. Improvements after placed in service are usually separate assets. Let's do a quick mini build. If you buy equipment for $4,000 plus $505 shipping and sales tax plus $250 installation, your basis is $4,755. That $4,755 is what you depreciate, not just the sticker price. Exam tip: if they say installed and tested, that's a clue. It's part of getting the asset ready for use, so it goes into basis. Harborview Realty makes a $200,000 down payment on a commercial building and assumes the seller's $120,000 mortgage. They also pay $4,000 in attorney's fees for perfecting title and $20,000 for permanent improvements before placing it into service. The property tax bill values the land at $70,000. What is Harborview's basis for depreciation? Think about it. The correct answer is $274,000. Start with total cost basis, $200,000 cash, plus the $120,000 assumed mortgage, plus $4,000 title legal fees, plus $20,000 improvements before service. That's $344,000. Then allocate out the non-depreciable land, subtract $70,000, you get $274,000 depreciable basis. A tempting wrong answer is $344,000 because people forget land isn't depreciated. Cedar Ridge buys an office building March 1st for $400,000. At purchase, they pay $1,400 legal fees and $200 deed recording fees. They start using the building a week after closing. 3 months later, they install wall-to-wall carpeting for $16,000 and later buy office furniture for $20,000. What is the cost basis of the building? Think about it. The correct answer is $401,600. The building's cost basis includes the purchase price plus acquisition and settlement costs, $400,000 plus $1,400 legal plus $200 recording. The carpeting was installed after the building was placed in service, so it's generally a separate depreciable improvement, not part of the building's original cost basis. The furniture is also a separate asset, which makes $416,000 a very tempting wrong choice.